Welcome to this week's episode of Financially Speaking. As a local family-built firm, Buska Retirement Solutions, along with its affiliate companies Buska Wealth Management and Legacy Tax Solutions, offer one-stop retirement, tax, and legacy planning services to families nearing or already enjoying retirement. Sue Buska is president of Buska Retirement Solutions, a retirement planning company helping develop financial, Medicare, and health insurance strategies. Over a decade ago, she partnered with her son, Cole Bruner. Cole, an investment advisor representative that's held to a fiduciary duty, is president of Buska Wealth Management, a fee-based registered investment advisory firm providing financial planning and investment management for individuals and businesses. Legacy Tax Solutions offers personal and business tax planning and preparation services. Their enrolled agent, Carl Van Setters, is a military veteran with over 10 years of accounting experience and is committed to maximizing your tax credits wherever possible. Over the last several years, Sue and Cole have continued to grow their team of private wealth advisors to meet the increasing demand of retirees seeking guidance. In 2018, Ryan Connor began serving clients at their Eau Claire location. At their Wausau location, Logan Wooler became a part of the team in 2020. And in 2023, Sue's daughter Kaylee Berenson joined the firm. As a family-built firm with offices in Wausau and Eau Claire, their dedicated team of professionals have the experience to provide custom-tailored strategies to help you achieve your long-term financial goals. The next 30 minutes will be filled with retirement information presented by their team in a simple manner that you can understand. So stay tuned because Financially Speaking starts right now.
In this segment, we've been getting a lot of questions about financial wellness and mental health.
While it can be scary to discover an error on your credit report, there are steps you can take to dispute that error.
Today, Ryan and I are going to talk about the Rule of 72.
And now for our weekly question and answer segment.
Welcome back to Financially Speaking. Today I'm joined by Cole and Kaylee from Buska Wealth Management and Buska Retirement Solutions. We're going to be answering some of your questions about planning for retirement. But before we do, if you're interested in seeing one of your questions answered on a future segment, please email us at info@retirewithbuska.com. Cole, Kaylee, thank you so much for joining me this afternoon. In this segment, we've been getting a lot of questions about financial wellness and mental health. So we're going to dive into some of those questions we received. And we're going to start with you, Cole. How can people improve their financial well-being?
Well, there's a variety of ways that they can improve their financial well-being, and it could have to do with, paying down, more high-interest credit card debt or any high-interest debt that they might have. Obviously, that's going to help improve their financial well-being because they are able to retain more of their money from month to month if they're able to get rid of some of those obligations. Also, prioritizing saving for our future. I think that's one of the easiest ways to, kind of maintain that financial well-being as we move out into the future is just knowing that we're building that nest egg for our future years. And also making sure that we're investing prudently, we're diversifying, and not only diversifying investments, but also diversifying tax qualifications, looking at the incorporation or the potential benefit of bringing, Roth into the equation, Roth IRAs, 401ks, those types of things, and just being aware that there's not one specific solution that works for everybody. That's what keeps our jobs really interesting, is it's always different, from client to client, from case to case, it's always going to be a little bit different. And so that allows us to really put our thinking caps on to figure out what's going to make the most sense for this client's unique circumstances. And so, obviously it's going to come full circle back to working with a financial professional. That's very important, but also making sure that that financial professional is, again, held to those fiduciary standards, that they're going to, have access to all of the different various solutions that would potentially make sense to you, to use for you, I should say, and that they're not beholden to specific, prefabricated prefabricated solutions or whatever it might be, that they're going to have to, figure out, how to fit your situation into that potential solution. So I think being proactive in pioneering saving, paying down high interest debt, working with a professional that has your best interest in mind, I think those are all really good ways to begin that that path to financial well-being, so to speak.
And it's really important. So I think a lot of people ask, what's the connection between financial stress and mental health? Kaylee, can you talk a little bit about that?
Absolutely. I think financial stress and mental health do go hand in hand together. I think if it's already hard making ends meet every month, then it can be a very, anxiety-provoking thing for a person who's providing for themselves or their family or whatever their current situation is. And honestly, it can start to consume a person. I mean, you can lose sleep over it. It can just be a total distraction at home, at work. So we have to make sure that we're, taking care of ourselves and recognizing those signs and trying to be proactive, like Cole said. So, you don't get down those rabbit holes.
So when we talk about the financial anxiety and financial stress, Cole, what are some of the things, Kaylee just mentioned one, but what are some other things that they can do to take control of that financial anxiety and stress?
Well, I think working with a variety of professionals can obviously help. I mean, certainly a financial professional is going to be able to kind of refocus our efforts and make sure that we're spending time focusing on the things that we can control, because there's always going to be elements of our financial planning that are out of our control. Obviously, we can't control when the next market downturn occurs. A lot of financial stress related to that one, right? I can't tell you how many times we get phone calls when the market goes down where people are just sheer panicking and things like that. And it's just that reminder that this is normal, this is part of investing, and we can't control the ups and downs of the market, but we can control how much exposure a client has to it. So making sure that they have the right allocation and reminding them of those types of things can really, really bring that stress level down. But also, other terms of other professionals, I should say, in terms of financial stress can be also indicative of other stress that's happening in our life. And I think that there is a stigma around, mental health and wellness and all of those different things, and whether it be counseling or therapy or what have you. I think having some of those professionals in your life can really be beneficial too, because at the end of the day, we all have stress. We all have anxiety to a certain degree about one thing or another, or maybe a lot of things in our lives. And sometimes that can be overwhelming, and we might not necessarily know how to handle that. And so having a good quality conversation with your financial professional is a good place to begin, but sometimes that's not where it ends, though. And so being open to the possibility that maybe it wouldn't hurt to have somebody that we can talk to, because sometimes we play a dual role, there's many times in our scenario where we're sitting and being a financial professional and a counselor at the same time. And it's fine, because there is a bit of crossover in that territory, but certainly we are not licensed mental health professionals. We want to make sure that if a client does have a need for that type of person in their life, somebody to talk to, somebody to hash out what's going on, and maybe help give them perspective from a mental health provider's standpoint, that could be really, really valuable in kind of recentering that focus, and then having the ability to know how to deal with that stress and anxiety when it bubbles up, because it's going to happen probably many times throughout the course of a person's future. And so if we know how to handle that stress, sometimes it will kind of head that off at the pass, so to speak. So we know, whether it be, practicing mindfulness or breathing exercises or what have you, a way to help bring that stress down, because that stress can then create other problems. There's a lot of health problems that are directly related to stress in our lives. And so certainly we don't want to affect life expectancy just because we didn't know how to deal with stress, especially financial related stress.
That's great. So we probably should talk about some resources that are available. I know Cole just talked about professionals, but Keely, what other resources do you think are available for our audience to address financial and mental health challenges?
Well, I think, the main resources is going to be educating yourself on, the basic foundation of finances, whether that's through books or online searches, or sitting down with a financial services professional and going over your plan and having it assessed and seeing if there's any red flags or anything to make sure that we're on the right track, or how do we get back on the right track. So those are some of those kind of resources. Otherwise, I do see a lot of value in living a healthy lifestyle and managing it through diet, exercise, and proper socialization, and managing, your work-life balance so it's not too stressful. And Cole had mentioned some of those resources, through therapy. So whether that's individualized or group therapy, or, talking to your doctor and just explaining your overall situation and seeing, if you could benefit from some help there. Otherwise, yes, talking about your situation with a financial advisor, making sure that you have a plan in place is going to be, the best proactive option for you.
Yeah, absolutely. Just looking for resources in general. There's a lot of resources out there. Obviously, we provide a lot of resources. We've got a couple of books that we've written for our clients. So, that's a good place to begin if you're trying to figure out, how do I even begin creating a retirement plan? Our book, Ready, Set, Retire, has been a really, really good resource for people that are trying to kind of get that broad view of all of the different various topics that relate to retirement planning and kind of drill into the ones that make the most sense for them to focus on. But relying on resources, both professional, personal. We all have people in our lives that we can talk to for most of the case. Whether it be family, kids, other relatives, friends, anything along those lines might help bring clarity to some of those situations. And also they may have, the ability to point you in the right direction. Maybe you should talk to this person, or you should check out this reference, or whatever it might be. So just talking openly and honestly with people about it, you'd be surprised how quickly people are willing to, help point you in the right direction if they have resources to provide.
So I'm hearing from both of you, have a plan and work the plan. And then seek help when you need it.
Right.
Got it. Yes. Got it. Well, thank you both for joining me today, and thank you for answering all of our questions.
Of course.
And thank you guys for joining us for this segment. We'll be back with more right after this.
The Tax Cuts and Jobs Act of 2017 reduced income taxes for many American households, but many of those provisions will expire on December 31, 2025 if Congress doesn't act. That could mean that you'll pay higher taxes, but you can take more control of your retirement by prepaying some of those taxes now at the current rate. Call us at 715-355-4445 or visit retirewithbuska.com for more information.
And now, our Financially Speaking weekly topic segment.
Welcome back to Financially Speaking. I'm Ryan Connor from Buska Retirement Solutions and Buska Wealth Management. In this episode, I'm going to talk about how to deal with a credit report error. While it can be scary to discover an error on your credit report, there are steps you can take to dispute that error. A U.S. News and World Report article titled "How to Dispute a Credit Report Error" provides useful information on this. Keeping an eye on your credit report is important, particularly if you plan to apply for a loan or at risk for identity theft, which could occur in the form of a data breach or fraud. Fortunately, anomalies are easy to spot if you know what to look for. First, look for these common credit report errors. Incorrect identifying details like your name or social security number. Accounts that aren't actually yours, including fraudulent accounts or accounts that belong to someone with a similar name. Open accounts that are reported as closed and vice versa. Accounts that list you as an owner rather than an authorized user. Accounts that are incorrectly shown as late or delinquent. Duplicate accounts. Incorrect delinquent dates, account opening dates, or last payment dates. Incorrect balances or credit limits. Credit inquiries that you didn't authorize. Public records such as bankruptcies that don't belong to you. Now, if you spot an error, the next step is to dispute it. You'll need to dispute the potential error with the credit bureau that created your report and the company that supplied the information, which is called the data furnisher. For example, if the error appears on 2 or 3 reports, say on Equifax and Experian, but not TransUnion, you'll need to reach out to both Equifax and Experian. As you prepare to make your case that a report contains an error, arm yourself with copies of these documents. Identifying documents with your correct name and address, like your driver's license. Correct bank statements that include things like your balance, credit limit, payment status, and account status. Any canceled checks, student loan disability letters, court documents like bankruptcy schedules, relief program agreements, letters from a lender showing an account error was rectified, proof that an account was opened via identity theft. Now, if your review uncovers errors or fraud, the article next suggests contacting the data furnisher. Even if you correct an error with one of the credit bureaus, until you've also corrected it with the data furnisher, the mistake will likely continue appearing on your credit report. For example, if you correct the spelling of your name with one of the bureaus but not the data furnisher, your credit report will continue showing the incorrect name. Data furnishers include banks, credit card companies, auto financing companies, collection agencies, utility companies, and real estate companies and organizations. Credit bureaus and data furnishers will reply to your dispute claim within 30 days. If you provide additional information during the investigation, it may take 45 days to receive a response. When a credit bureau completes an investigation, it's required to notify you of the results within 5 business days. The bureau could do one of the following: make no changes to your report, update your report, delete the information from your report. Now, if you disagree with the investigation's outcome, you can dispute the error again and include additional information, or have the agency send you the materials it used to make its decision. You can also report the credit bureau by filing a complaint with the Federal Trade Commission or Consumer Financial Protection Bureau if you think your concerns are not being taken seriously. Another option is to draft a statement of dispute that can be included on your credit report. Stick to 100 words and be aware that creditors aren't obligated to accept it. Finally, you'll want to review your new report. Once the credit bureau resolves the dispute, they will send you an updated report. Now, before I sign off, I want to circle back to the topic of identity theft. According to an Investopedia article titled, "Is My 401k Safe from Hackers?" employer-sponsored retirement accounts are hotspots for hackers. Hackers know that they contain more money than savings accounts typically do, and that they can steal it from you before you even notice the money is gone. Just like monitoring your credit reports can help you spot identity theft, keeping an eye on your retirement account can alert you to any suspicious activity. You may also want to consider creating a long, unique password that hackers will have a very difficult time guessing. The article says hackers can crack an 8-character password within a week, while a 16-character password would take about 147 trillion years to decipher. Using multi-factor authentication can help as well, as also avoiding free Wi-Fi when you're logging into your retirement account. Identity thieves and hackers can put a real damper on your retirement plans, but if you take the right precautions, you can defend yourself and your accounts. Now, if you have questions about errors on your credit report or about other aspects of your financial well-being and strategy, contact our office today at retirewithbuska.com or give us a call at 715-355-4445. We'll be right back with more Financially Speaking after this.
Have you heard the term fiduciary before? According to Investopedia.com, being a fiduciary means being legally bound to put your client's best interest ahead of your own. Did you know that investment advisors have a fiduciary duty to clients, but broker-dealers just have to meet the less stringent suitability standard, which doesn't require putting their client's best interest ahead of their own? At Buska Wealth Management, all of our advisors are fiduciaries to provide our clients more peace of mind. Call us today or go online to schedule your complimentary review.
And now our Financially Speaking weekly desk segment.
Welcome back to Financially Speaking. I'm Cole Bruder from Buska Retirement Solutions and Buska Wealth Management. And joining me today is Ryan Connor. Today, Ryan and I are going to talk about the Rule of 72.
Ooh, sounds like we're going to get into some math today.
That's right. Today we're going to talk about equations, but the fun kind.
What is a fun equation?
Well, the kind that helps make you money.
Gotcha. Equations that make you money are indeed fun. I was afraid we were going to have to talk about pi.
What kind of pi are you talking about?
The number you use to calculate the circumference of a circle.
Well, I don't see any reason to ever discuss pi on our show.
Fair enough. So Cole, what is the Rule of 72?
Well, Investopedia covered it in an article titled The Rule of 72, Definition, Usefulness, and How to Use It.
Great. So what's the bite-sized definition of the Rule of 72?
Well, in the simplest terms, the Rule of 72 is a formula that you can use to estimate the number of years required to double the money that you've invested at a given annual rate of return.
Don't programs like Microsoft Excel have the ability to calculate the time it takes for your money to double?
Well, yes. However, with the Rule of 72, you can do quick mental calculations. It helps you get an idea of how much an investment may be worth.
I see. That's why they teach the Rule of 72 to beginning investors. It's easy to understand and it's easy to use.
That's right.
All right, so how do you actually do the calculation?
Well, there are a couple of ways to do it. First, you can figure out how long it will take an investment to double by dividing the number 72 by the expected rate of return.
So what is an expected rate of return?
Well, the Investopedia article provides several examples. The first one is gross domestic product, which typically grows at a rate of 4%. 4% is the expected rate of return.
All right, 72 divided by 4 is 18. Thus, we can expect the GDP to double over 18 years.
That's correct.
So if I have a bank account that pays me 4.2% interest, it will take 17.14 years to double.
Exactly right.
That's quite a long time.
Well, investing and saving are marathons, not sprints.
Good point. So what about the other formula, the one that tells you the expected rate of return?
Well, to do the other calculation, you divide 72 by the number of years, and that will give you your expected rate of return.
All right, so then I take 72, divide it by 10 to get the rate of return, which would be 7.2. So you'd need a 7.2% rate of return for your money to double within 10 years.
That's exactly right.
So what are some other ways to use this equation?
Well, you can also use it to calculate how quickly your credit card balance will grow. Say your credit card has a 12% interest rate. At that rate, the amount you owe will double within the next 6 years.
And don't let that happen, viewers. Pay your credit card balances down.
Absolutely, you've got that right, Ryan. And in my opinion, the same applies to student loans. Over time, the balance can grow if you don't make payments on the principal. If you think you're making interest-only payments on a student loan, you should try to add at least a little bit to that so that some of what you're paying goes towards your principal.
I agree, and I would add that I think it's a good idea to stop making interest-only payments as soon as you can afford to pay more.
That's another way to use the calculation, how long it will take a student loan balance to double. If borrowers make that calculation when it's time to start paying the loans back, they could possibly avoid situations where they end up paying a lot more than what the loan was originally worth.
Because they'd understand that the value of the loan would double. Is that what you mean?
Exactly. And they'd have a clearer picture of how much time they have before the amount grows beyond a manageable level.
So if our viewers have kids or grandkids who are college age, they should sit down with them and go over the Rule of 72.
Absolutely. I think that's a great idea.
All right, so let's move on. Who came up with the Rule of 72?
Well, actually, it goes all the way back to 1494.
The year that Columbus sailed the ocean blue?
That was actually 1492.
Okay, so what happened in 1494?
Well, in 1494, a mathematician wrote a book called Summa de Arithmetica, which included the Rule of 72.
Well, I'm surprised it goes back that far. Now, how accurate is the Rule of 72?
Well, it's important to remember that while it's pretty accurate, it is an approximation. If you need a very exact number, that function in Microsoft Excel might yield a more precise result.
Now, that's good to know. Does the Rule of 72 have any particular limitations?
Well, that's a great question, Ryan. So the Rule of 72 works best for rates of return in the range of 6 and 10%. Beyond that, you'll get a more accurate calculation if you adjust the formula a little bit. To do that, you just have to add or subtract from 72. You subtract or add 1 from 72 for every 3 points the interest rate diverges from 8%. For example, if the rate of return is 3 points higher than 8%, you'd add 1 point.
So then it becomes the Rule of 73.
That's exactly right.
Now, what if you have an investment offering that has a potential 22% rate of return?
Well, that's over the 8% threshold by 14 points. You have to divide 14 by 3, which gives you 4.67. Let's just call that 5. Add 5 to 72 and you get 77. So to find out how long it will take for that investment to double, you'll need the rule of 77.
You weren't kidding when you said we'd be doing a lot of math today.
That's right. The road to financial success is paved with math problems.
So what about annuities? Does the rule of 72 apply to those as well?
Well, sure. A fixed indexed annuity will grow exponentially over time. So the rule of 72 can tell you how long it will take that investment to double. The calculation may be harder to do with variable rate annuities, however.
And that makes sense to me.
Well, Ryan, I think we've thoroughly covered the rule of 72 during this segment, but we have a couple of minutes left. So what else should we cover today?
Well, I think since we've been talking about how long it takes for investments to double, we should talk about when people should start investing. Is it ever too early to start investing?
It's never too early. Why do you think so many grandmas buy savings bonds for their grandkids before they're even old enough to talk?
Kids hate getting those as gifts.
Kids' appreciation of savings bonds is just like the bonds themselves. Interest grows over time.
That's a good one.
Thank you.
But you are right. One of Investopedia's frequently asked questions about investing is, when should I start? And the answer is, as soon as you can afford to. Investment returns compound. So the sooner you get started with investing, the more you can take advantage of that.
Now, I think a lot of people are afraid to start investing early on in their careers because they may not have a lot of room in their budgets. But even putting aside a small amount can add up over time.
That's right. Plus, you can start with a small amount and increase it over time as you have more room to do so.
A financial services professional can help you figure out how much you can afford to invest. So remember that you don't have to do any of this alone.
That's right, Cole. And if you'd like to talk about your retirement strategy, contact our office today at retirewithbuska.com or give us a call at 715-355-4445. We'll be right back with more Financially Speaking after this.
Are you looking for someone to help make retirement planning a little easier? I'm Cole Bruner from Buska Retirement Solutions, Buska Wealth Management, and Legacy Tax Solutions. Between our three companies, there's a lot we can do to make your retirement planning process less stressful. By creating a holistic retirement plan that incorporates investment management, income planning, tax planning, as well as health insurance and Medicare planning, you can retire with more confidence and peace of mind. Call us today or go online to schedule your complimentary review.
Thank you for tuning in to this week's edition of Financially Speaking. We're glad you were able to join us today, and we hope you learned some useful retirement tips along the way.
On today's show, we covered a number of important topics, and hopefully we did so in a manner that was easy for you to understand. Now, this is the same way that we communicate to our clients when we meet with them in person. Remember, with the help of the right financial services professional, you can create a quality retirement, and our team is here to help. Right now may be a great time to get a second opinion on your retirement plan. So call us at 715-355-4445 or go to retirewithbuska.com to continue your retirement education, catch up on some previous episodes of our TV and radio show, or to schedule your complimentary no-obligation consultation.
Now, if you have any questions or comments about today's show, give us a call at 715-355-4445 or feel free to send us an email at info@retirewithbuska.com. Join us next week at the same time and same place for another episode of Financially Speaking.